Welcome everyone to today's session on how we measure impact at Sonen Capital. My name is Armando Balbuena, Senior Marketing Manager at Sonen, and your moderator for today's webinar. Your participation is encouraged, so please submit questions using the questions panel. Throughout the presentation, I'll be reviewing the questions coming in, and we can answer as many of them as possible at the end of the session. Those questions, however, that remain unanswered will be addressed and emailed out to everyone, along with a link of the audio recording of this webinar. We absolutely appreciate and respect your time. So from start to finish, we're aiming at just over half an hour for this session. Now, the agenda. As you see here, we're going to walk through the 5 different ways we measure impact at Sonen across our various investment strategies. I'm pleased to be here with Sonen Capital's Head of Impact, Will Morgan, who is the lead author of the Impact Report. Will has been working in the field of impact measurement for about 15 years. He leads Sonen's efforts to define, evaluate, and report impact across Sonen's public and private markets investment strategies, much of what you'll see here today. Will, good morning. Take it away.
Thanks, Armando, and thanks to everyone for participating today. I'm going to walk through the 5 distinct ways we measure and evaluate impact across our investment strategies. It's going to be a little dense. Please do submit any clarifying questions. If I can't answer them today, we will be glad to get back to you after the webinar in written form like we do with most of our webinars. To begin, the most fundamental and high-level way Sonen qualifies impact relies heavily on this chart, which we created at the inception of the firm in 2011. We call this diagram the impact investing spectrum, and it helps provide what we think is a basic taxonomy, which is sorely lacking in this industry for various different impact investments. This chart shows that impact investing is comprised of a wide variety of options for investors. It's not simply a choice of impact or no impact, but rather a spectrum of choices to pursue impact creation. Our strategies are focused largely on the 2 middle columns in this chart: sustainable investments and thematic investments. So the easiest way to think about this is how companies conduct themselves versus what companies do. How companies do it really constitutes the sustainable investments bucket. That is, what do business operations look like? How's the labor force being treated? What kind of governance is in place? Compare this to what companies do, which is the thematic bucket. This is where goods and services sold relate squarely to a social or environmental needs, such as water or energy efficiency or the increasing rates of urbanization we see around the planet. So this sustainable and thematic bifurcation and qualification applies across cash, fixed income, public equity, real assets, and even hedge strategies. The way we qualify any security as thematic or sustainable is through business revenues or through identifying the primary activity of the security, where a company derives the majority of its income, or what projects are actually being undertaken. For example, if company X derives more than 50% of its revenues from water purification, we would qualify that investment as thematic, and the theme would be water. The source of business revenues really determines that thematic qualification. In this slide here, you can see the basic composition of our 2 public market strategies, and in both cases we see around 42% of each strategy is qualified as thematic, and the balance qualified as sustainable. In this chart, depicting our fixed income strategy, we can identify the primary business activity to determine the thematic qualifications of underlying securities. That's the inner pie there, the inside circle. We can further define this evaluation to identify subsectors of business activities, and we can provide thus more detail about the true complexion of our strategies, and that's the outer circle. So in this case, note the energy slice to the pie at the upper right, comprising 25% of the thematic exposure in blue there. We can further define energy to be comprised of a series of subsectors, which include clean power generation, energy-related technologies, and energy efficiency projects. Our quarterly reports that our investors receive include examples of each of these subsectors with specific securities and what specific securities are doing to earn that thematic qualification.
Hey, Will, if you go back to slide 5, please. For context, what's a typical clean power generation project in fixed income?
Yes, so that would be, for example, we have one fixed income security that's a regional utility that's installing solar panels for municipal level power generation, for example. And we have another example of that a little bit later in the presentation today. Okay, so that's the first method we use to qualify impact. The second is how we evaluate impact performance is the use of environmental, social, and governance data, often called ESG. And this information, we think, helps investors examine non-financial dimensions of underlying investments. We use the ESG data to compare the impact performance of our public equity strategy relative to a conventional market benchmark, in our case, the MSCI All Country World Index. We think ESG data is useful for a number of reasons. First, it's a huge collection of non-financial information which affords investors a number of different ways that they can examine their investments in a more or less unconventional manner. Second, because this data is getting so much more numerous and ubiquitous, investors can use it in increasingly creative ways to test portfolio alignment with personal or institutional values, or they could screen out undesirable issues or performance from investment portfolios. Our ESG analysis comprises 8 individual ESG data points listed here in this table. We've selected these performance indicators because of their relevance to issues of concern among impact investors and because, frankly, these data points are some of the most widely reported across the private sector. We'll go through a couple of examples of ESG performance in the next couple of slides. The first is carbon emissions. Among the two of the data points we evaluate in the environmental category. This shows carbon emissions from the 10 most carbon intensive industries in the All Country World Index benchmark. Again, that's what we use to compare financial performance and impact performance. So among these 10 most carbon intensive industries, we can see that Sonen maintained exposure only to a handful of those, which are colored in green on the chart. For each of those industries, you can see Sonen's holdings maintain a significantly lower carbon emissions profile than that of the benchmark. And we think this illustrates our strategy's bias to first avoid companies that are most carbon intensive to begin with, and second, to select the best performers for those securities that are carbon intensive.
Will, if there's a company within this that we find has a wildly out of proportion contribution to carbon intensity, can we choose not to be in it?
The answer to that is yes, we can choose to divest from such a holding. But you know, I think that's the thing that's the benefit of ESG data for investors, is that they can begin now to look at these kinds of performance attributes of a single company or of a portfolio and decide whether or not that's consistent with what they want or whether or not it compares favorably to industry peers or otherwise. I think it just gives investors a new way to look at the non-financial complexion of a portfolio. I'm going to keep going here on environmental evaluation. In this, we're examining average carbon intensity. So the measure of intensity helps normalize comparisons between companies of potentially vastly different sizes. Intensity reports the tons of carbon emitted per unit of sales. So here we can see Sonen's public equity strategy in green. The intensity is 201 tons per $1 million of sales, and for the ACWI benchmark, it is 286 tons per $1 million of sales. Another way we can take a look at carbon intensity is through a trend analysis. So in this chart, we've taken the names of our public equity strategy as of the end of 2016, and we simply measured their collective emissions for the last 5 years. Ideally, what we'd see is a downward trend, revealing that these companies are indeed steadily reducing the amount of carbon it takes to produce 1 unit of economic output. So in contrast, take a look at the ACWI's trend line in the tan or the brown color. Not only is it larger in absolute terms, but the trend line is positive. It's going up and to the right, meaning that this collection of companies is actually increasing aggregate emissions over the period. Next, moving on to social performance, we'll look at labor management, which is one of the 3 different variables we consider in the social part of the evaluation. In this case, labor management essentially relays the satisfaction of a company's workforce. Do workers receive competitive benefits? How do the benefits compare to industry peers? Do they benefit from performance incentives? And are there things like professional development opportunities made available to them? So here we see Sonen's average score, again in the green, is actually slightly less than that of the benchmark, 4.97 versus 5.1. So that's not a lot, but nonetheless, it is underperformance. And this shows how such an analysis can help provide ongoing, real-time monitoring into considerations like workforce well-being. So in this case, due to the slight underperformance, investors have the choice of taking a look at how they might improve such performance or identifying the specific companies that are bringing that average down. And there's an opportunity now to talk directly to management or to regularly check that score to see if conditions may have improved and possibly removing the major violators from the portfolio altogether. Just to provide a little more color on how these scores are rendered and what really constitutes a, quote, good performance in labor management, we'll take a look at Philips, which is in our public equity strategy. Philips is a manufacturer of lighting products and healthcare products, and it receives pretty high scores on labor management due to a number of factors. First, it has one of the most widely available stock ownership plans in the industry, and employees are able to participate at up to a 20% discount on the stock price purchase. It has a strong focus on employee training and leadership development, and the unionization of Philips employees is estimated to be around 50%, where the industry average is 21%. Now, a financial analyst may look at that data point and consider such a high rate of unionization to be a high risk of labor disruption and a collective strike, for example. But for the impact investor, we think that's probably indicative of a workforce that's being taken care of and that has at least a modicum of some protection of employees' rights. So hopefully this empirical look at Philips provides a little more clarity on how these performance scores are actually applied and rendered. Next, we'll move on to governance. And in this case, we're going to highlight just gender diversity on the board. Again, this is one of 3 different factors that we evaluate with respect to governance. On the far left, what we're depicting there is the average percentage of women on corporate boards among Sonen's public equity securities compared to the benchmark. So we see 19.5% for Sonen's strategies versus 15.2% for the benchmark. But I think maybe of more interest is the chart on the far right, which reports the percent of companies that are reporting 0 women on the board. And in that case, it's under 10% for Sonen's strategy, but it's over 25% for the benchmark. So that wraps up the ESG methodology. That's a quick drive-by. The next methodology by which we are evaluating and reporting impact is through the UN Sustainable Development Agenda. As a reminder, the UN Agenda for Sustainable Development was introduced in mid-2015, and it consists of exactly 17 different goals that ultimately are intended to bring our planet to social, economic, and environmental sustainability. Most importantly, in our view, these so-called Sustainable Development Goals, or SDGs, invite the private sector, the businesses and investors to actively take part in this agenda. And using these goals, we think we can understand our relative contribution to global sustainability. We originally introduced this idea of evaluating our investment strategies in our last year's impact report, the 2015 impact report, which we think was a first for the investment industry. And this year, we've taken our analysis even deeper to examine specific impact indicators that the UN itself has suggested that we use to track our collective progress. So first, as an example of this analysis, we'll look at SDG 7, which is ensuring access to affordable, reliable, and sustainable energy for all. And the targets for this goal are in boxes, the boxes on the left, 7.2 and 7.3. Those are to increase the proportion of renewable energy in the total global energy mix, and second, to double the rate of energy intensity improvement. And again, energy intensity measures the amount of energy that's required to produce 1 unit of economic output. During 2016, about the middle of last year, an external UN working group released a series of impact indicators corresponding to each SDG that we are supposed to use to evaluate our progress. In the boxes on the right, 7.2.1 and 7.3.1, sorry, at the right show these indicators. Those are the actual renewable energy share and total energy consumption measured by a percent, and second, the energy intensity measured at the national level through national level energy consumption. So we have applied these indicators to our investment strategies to accomplish what we think are 2 important goals. The first is to determine the true extent to which our investments at the security level and at the collective strategy level may be contributing to various SDGs. And second, to report in definitive terms, wherever possible, what those contributions actually are. So this slide here illustrates how we endeavor to report on our accomplishments towards SDG 7. The first indicator proposed by the UN is the share of renewable energy in the total final energy consumption. So specific data that we're using as a proxy for that information include the total number of megawatt hours of clean energy produced in a year, the total amount of renewable energy power generation capacity, and last, the proportion of a national grid that may be powered by renewable energy. So in one example, we have made a clean energy investment in a micro hydro energy production facility in Uganda. And we know in this case that that single facility is providing a total of nearly 3% of the total energy in that country's energy infrastructure. Next, looking at with more precision at indicator 7.3.1, which again relates to energy consumption in the form of intensity. This chart at right is the one we saw a little earlier, and it depicts the 5-year trend in average carbon emissions between our public equity strategy and the ACWI benchmark. So we've performed this analysis with our sovereign bond portfolio as well, and which reveals a similar trend. So reducing carbon intensity is an explicit goal, and it's an indicator for SDG 7, and we can use some very specific data to illustrate our various different strategies' consistency with that goal and that progress.
Will, before we move on, someone had a question on the y-axis we've been using on these charts, the tons of CO2 per $1 million in sales. Can you just explain what that means?
Sure. So it's just a way to try to normalize how much energy it takes to produce a unit of economic output. So we know that companies that are very small are going to just necessarily produce less carbon emissions than companies that are very big. But what we can try to do to compare them and give them a more apples to apples comparison is divide that by a unit of sales. So for every $1 of sales that a company may generate, how much carbon does it have to spew into the atmosphere? And that metric, the intensity, is a nice way to compare things that are wildly different in size, but still to get an idea of what their relative contribution to climate change may be.
Thank you, sir. Okay. And it's definitely clarifying. But someone else asks, and because we've been seeing it on each of the charts here, what's the MSCI ACWI and why do we use it?
Okay, the MSCI is the All Country World Index, and that is the benchmark to which we gauge our financial performance, outperformance or underperformance. And we have decided to use that also as our sustainability comparison, our impact performance comparison. We wanted to compare the financial performance to a conventional market benchmark, and we also want to compare the impact performance to a conventional market benchmark. So that's why we've used that, and we're using that specifically because it has a global orientation and which is reflective of our public equity strategy.
Thank you.
Okay, moving on from the UN SDGs, we are now going to talk about Sonen's Aims framework. We introduced this framework in 2014 with the intention of helping investors understand how impact is created and delivered across disparate asset classes and otherwise similar investments. Too often we think about investments as either having impact or not having impact, and it really is not a binary choice. There's a lot of gray area in between those two extremes. Further, there's this fixation on the concept of additionality, and additionality is how an investor's dollar results in incremental change that otherwise would not have happened. And while additionality is essential in understanding impact creation and the role of impact investors, we think it minimizes the impact potential of investments that do not express impact through additionality alone. So AIMS is an acronym for additionality, intentionality, measurability, and scale. And we think capturing these four dimensions together in a variety of ways helps relay the impact that any single investment can make, and particularly helps contrast similar investments. So to briefly define the other dimensions of the framework, intentionality is making an investment with the intention of achieving a specific impact objective. So this can often be evaluated through corporate policy implementation, which we think reflects efforts to achieve specific outcomes. Measurability is the extent to which impact outputs can actually be observed, measured, and quantified. And this varies tremendously across asset classes and even similar investments. Just because impact cannot easily be measured does not mean that it does not exist. And scale simply relays the size and the amount of impact achieved by a particular investment. So we conduct this qualitative evaluation across all asset classes, and for today we thought the best way to convey the concept was to simply contrast two similar investments in one asset class, in this case fixed income. And this is an analysis we did do in the impact report as well. First, this will contrast a sustainable fixed income corporate bond issuance on the left. In that case, it's a corporation that is performing well along E, S, or G dimensions. And this is a general issuance, meaning that proceeds are used to finance general business activity. The thematic fixed income on the right consists of a corporate green bond, an actual security that we own. Specifically in this case for a regional utility in the Southeast US that builds solar power generation facilities. That's the example I mentioned earlier. So let's walk through aims for each. So in additionality, depending on the size of this bond issuance, additionality, again, the incremental positive impact that can be attributable to an investor's dollar, it could be low or high. So smaller issuance for bonds tends to result in larger investor intentionality. It's just a function of mathematics. So smaller pools of capital mean that individual investments are proportionally larger. In this example, we qualify the additionality as medium in both cases just because the size of the issuance was very similar and the scale of implementation was very similar. Intentionality, the sustainable corporate bond was selected for its ESG performance and attributes, and thus we think that reflects proactive corporate policy choices, which is a clear proxy for intentionality. Depending on the depth or breadth of those policy choices, intentionality might toggle up or down. In the case of the thematic corporate bond, the green bond, this issuance is underwriting specific environmental projects that deliver very tangible, quantifiable environmental impacts, and thus we think reflects a very high degree of impact intentionality. In the case of measurability, again, the observable impacts of specific investments are not always measurable, although we may know that such impacts exist. So in the case of the general corporate bond issue, even if the ESG performance of that corporate entity may be through the roof, may be stellar, it's almost impossible to know what kinds of activities or project a general issue bond may be supporting. So thus, measurability in this case is qualified as low. For thematic bonds, however, like this corporate green bond, they often articulate specific environmental outputs, like how many solar panels will be installed or what kind of energy efficiency results will improve from retrofitting a fleet of vehicles, for example. So measurability in this case is relatively high. Last, for scale, the depth, the breadth, and the durability of impact is a critical factor that is often overlooked in impact evaluation. Scale is often proportional to a bond's size, not surprisingly. In both of these examples, scale is relatively high. The ESG implementation that's occurring across the entire corporate entity for the sustainable security versus the size of the solar installations and the durability of their benefits in the green bond, they're both quite significant, and we've qualified them both as high. We see scale varying most depending on the size of the issuance, as I said. So consider World Bank green bonds issued in billions of dollars, and then smaller municipal bonds issued perhaps in tens of millions of dollars. We just know that as a function of size, the scale of those two impacts will be necessarily different. So we hope this provides some clarity on our Ames framework, and our impact report, again, provides more examples of this kind of analysis. Okay, the last way in which we communicate impact is through actual quantitative data using the impact and reporting and investment standards from IRIS. And we think this gives investors an unambiguous way in which they can understand the impact of their investments. So we like to highlight the use of IRIS for a couple of reasons. First, we do want to embrace this nascent industry's increased use of standardized impact data in an effort to increase standardization generally. At large, we just must move towards greater uniformity in the terms we use, and in particular, how we communicate impact. Next, using standardized data has a very practical benefit for us of easing our ability to aggregate impact data and be sure that there's some consistency between similar data points. This is particularly useful in our real asset strategy, as we are investing in multiple similar strategies, and they must be able to communicate impact in uniform terms. In our real asset strategy, we use a set of 17 core IRIS indicators that we think relay specific data about our investments in clean energy and in sustainable timber and green real estate. In this table, we've highlighted the change of some of those performance indicators over the course of 2016. So the column at the far right indicates what actually the delta between the end of 2015 and the end of 2016. So if we look at the top line, we can see total megawatt hours generated from renewable sources, which increased by over 1 million megawatt hours. Looking at the sustainable timber section, that first indicator, number 1, shows that our investments increased the total land under sustainable management by 34,000 acres. And similarly, the third line there, land permanently conserved, reveals that we have 7,000 acres more that will benefit from permanent conservation. And last, in green real estate, our underlying strategies are based in the US and in South Africa for green buildings. And they've collectively saved over 7 million kilowatt hours of energy through energy efficiency retrofits and efficient construction. And last, we've constructed more than 4,300 units of housing in extremely constrained markets, 72% of which have some sort of sustainability certification attached to them. A final note about our real asset strategy before I wrap up here is that beyond these 3 sectors, we plan to add investments in sustainable agriculture and environmental infrastructure. And each of those also has a corresponding set of IRIS indicators that we will use to communicate impact. So I know that was a mouthful. Thank you for listening to this lengthy presentation. Just to remind you of what we went over, we have 5 ways that we try to capture impact data and relay impact creation across that asset classes. The first was the impact investing spectrum. The second is the use and integration of environmental, social, and governance data. The third was using the United Nations Sustainable Development Goals as a reporting framework with corresponding impact indicators. Fourth is our Ames framework, an internal tool that we use. And last is the use of hard quantitative data using IRIS indicators for our real assets-based investments. Thanks for your time, and I hope we have time to answer a few questions. I see time's a little tight. Mondo?
Time is indeed tight, and I don't know if it's good or bad, but we got a lot of questions, and some skeptical, some really digging much deeper than I know we're going to have time to go through here. But I want to remind everyone that every webinar we've ever had, we respond to 100% of the questions that we received in an email, along with a link to the recording of this webinar, and we send it to everyone, and we post it on our website. So fear not if we don't have time to respond in the moment. But I want to go through a couple of, maybe not softball, but I guess where we have people skeptical of how we measure impact. So in my first question here, I guess, how are thematic qualifications made? Or as someone else said, how do you determine what is a thematic security versus what is a sustainable one?
Sure. There's two ways. First, in some cases, we are selecting securities specifically on their ESG attributes, in which case we know the business doesn't have a direct relationship with a social or environmental issue such as energy or water, but rather that we're trying to pick the companies that have exemplified the best practices along environmental, social, or governance lines. So in that case, the securities selection itself is a sustainable approach, which means we're actively, explicitly integrating ESG as part of the selection process. With respect to thematic securities, you know, a lot of people will say we've invested in a water company, but if you take a look and really kick the tires, there's a very small amount of the business is really related squarely to water. So what we've decided to do is include a threshold of revenues, which is 50% of the revenues from a company must relate squarely to a specific theme, such as water, in order for it to be qualified as thematic. Okay.
Another, what seems like a skeptical question here is, does ESG data really communicate impact?
Yes, good question. Something we hear pretty often. So I think ESG data can help communicate relative performance between one company and another, or one whole entire portfolio or strategy versus another, or a strategy against a benchmark. So it may not relay impact creation as we think about it in terms of additionality, but it does help reveal some of the impact attributes of one security or one collection of securities, and the intentions of one investment compared to another. And I think it provides an opportunity to contrast similar investments. I do think that if you're given the choice, if you look at ESG data that we showed you before, when you can take a look at the absolute carbon emissions of one portfolio versus another, it does give investors an idea of, as they are investing for financial gain, they can also think about what kind of impact it has on the planet. And there is a demonstrable and undeniable difference between companies that are producing 2 tons of carbon per unit of sales versus companies that are producing 20 tons of carbon per unit of sales. And so I think you can, without making too much of a stretch, imagine that ESG data is helping provide an idea of what impact looks like from one security to the next.
Thank you, Will. I love this question. And we had a few on Ames. Ames seems pretty squishy. It seems like any single investment could be described in multiple ways with that framework. Well, it's more of a skepticism than a question, but let's hear your response.
Okay. Well, yeah, I mean, Ames is a highly subjective process, but we do think it helps provide some contrast between similar investments. You know, we came up with the idea because we know that for a lot of investments, impact is indeed delivered, but it's not always easily described by the concept of additionality alone. Take a muni bond, for example. We know that financing from a bond can be earmarked and used specifically for water and sewerage infrastructure. And we all know that that's good. But how could we possibly measure the results of such a bond? Measurability in that case is low, but intrinsically we know that that muni bond is providing a tangible benefit to the community. So this is our attempt to try to capture how impact is delivered beyond the opportunity we have to count the outputs. But yes, we're working on a way to make that framework more standardized and quantifiable, and which may allay some of the concerns about its usefulness. But I appreciate the comment. Squishy's a new one.
Indeed. What is next for the UN Sustainable Development Goals? Do you think it would be adopted by the private sector, and has the UN issued guidelines in connection with the SDGs, and to what extent do we use them?
Yeah, so I mean, the aspiration for the SDGs is very clear that they want the business and the private sector to be a big part of that, and they're actually relying on the private sector to provide much of the financing that will be required to achieve some of these goals. We've seen announcement from some big investors and big investment firms about explicitly dedicating more resources to the SDGs and directing serious sums of money to accomplish some of those goals. So we think that's good news. The challenge is kind of the practical issue of how the private sector begins to understand how it could make tangible contributions to those outcomes, how it might be able to evaluate its outputs and its actual contributions that they're able to make through their business activity. But there are more and more resources out there that can help investors and the private sector in particular navigate some of those issues. There's something called the SDG Compass Guide, which we used last year, and which is widely circulated, and it's a useful resource for how the private sector could actually activate resources with the intention of moving the needle on some of these issues.
You know, as a lot of people attending this webinar are investors, and one would like to know, how can investors start integrating the Sustainable Development Goals into their own decision making?
Yeah, great questions. So, you know, I think the easiest way to start that is to actually, and this sounds pretty rudimentary, but just take a look at what your assets are doing. Using that impact spectrum that we introduced earlier is a good start. Do you know what the core business activities are of these underlying investments? What's the selection rationale and the investment decision-making process from your own asset manager? It's not difficult for investors to ascertain the primary business activity of the names in their portfolios, and that's not a bad place to start. For example, if you're looking at a water company, you can see what kinds of activities that company may be doing, and and you can look at the specific goals for, I think it's SDG 6 has to do with water, and the goals and the targets and the specific indicators for that particular sustainable development goal. And you can quickly do a litmus test and an intuitive judgment about whether or not a company that's involved in water with a specific industry and the activities that it's doing is at all related to some of the aspirations of the SDGs, because the SDGs are clearly thought out, they're well articulated, and the indicators are not always easily usable, but they clearly point, they provide an easy way to qualify whether a company is aligned with that goal or not.
Thanks, Will. I'm gonna just let everyone know that we're just gonna take two more questions. You know, initially when we were putting together this presentation together, we were thinking of calling it the 7 ways that Sonen measures impact. So one of the other focus areas that we didn't touch on today is what someone had a question on, which is of shareholder engagement. What are you doing, and you know, if you're doing something, what's next?
Yeah, I'm glad someone brought that up, because that's not wasn't part of this presentation, but it is written about in our annual impact report, and it does form a pretty central part of our idea of how we create impact. I mean, directly engaging with companies in concert with other investors is one of the most clear examples of how to directly effectuate some change, and also adds to the investor additionality aspect, if we want to use if we refer to the Ames framework. So shareholder engagement remains a focus, and largely it's about monitoring ESG performance of underlying securities and advocating directly around key areas such as sustainability reporting, transparency and reporting, workforce diversity, and good governance practices. Basically, the foundation of our shareholder engagement program is making good companies better, and we've been very successful in lending our voice to the dialogue, advocating on behalf of integrating sustainability reporting, especially, which is of interest to a wide array of investors. And we enjoy the benefit of working alongside other institutional investors so we can really amplify our voice. But many of them are asking for more transparency, because I think this is where it all starts. We need to know how companies are performing along ESG dimensions, and then we can decide whether that's good or bad, and then we can begin to agitate for an improvement in specific aspects.
And last, which I also think of as the seventh way in which we might measure impact, have we considered science-based targets for some of our asset classes?
Surprised to hear that question, but the answer is yes. The reporting that we've done to date is more of a footprint. So when we look at the carbon intensity values and the carbon trends that I showed you earlier, that really is kind of a point in time, trying to understand how well a company or a suite of companies is performing relative to another suite of companies or an index, for example. So, that's kind of a snapshot. And I think that is revealing as far as impact performance, but we have come to think that we need to be able to provide environmental performance and carbon emissions in particular as they relate to some sort of climate imperative or some sort of scientific imperative. So we've begun to look at our public equity portfolio and compare it to a science-based target line. And basically that line is saying, we know that to avoid the 2-degree scenario by 2050, we have to reduce carbon emissions by a very specific amount. The International Energy Agency knows that we have to reduce carbon emissions by a specific amount each year, and each industry has to do its own respective thing. What we want to do is take a look at our collection of companies and evaluate whether or not they are reducing their emissions, which we anticipate they are, and the data shows that they are, but whether or not those reductions are adequate in order to avoid the 2-degree scenarios. So we have begun and commenced that analysis, and we hope to release some results of that in mid-2017.
Thank you, sir. That concludes our webinar for the day. We have a lot of questions we didn't get to, so we'll start working on those today, and we'll send them out sometime next week. On behalf of Will Morgan and myself, thank you so very much for your time. Have an excellent day.